Hi students, good morning. I am Dr. Majini Jaspalla, Assistant Professor. From this class, we are going to learn about default and repossession. Unit 11, Block 3. First, we can see the introduction of default and repossession. In a hire purchase agreement, the hire purchaser has to pay up to the last installment to obtain the ownership of goods. If the hire purchaser fails to pay any of the installments, the hire vendor takes the assets back in its actual without any refund of the earlier payments to the hire purchaser. The amounts received from the hire purchaser through down payment and installment are treated as the hire charges by the hire vendor. This act of recovery of repossession of the asset is termed as repossession. Repossessed assets are resold to any other customer after repairing or reconditioning. If it is necessary, they will do it, and accounting figures relating to repossessed assets are segregated from the normal hire purchase entries. Repossessions other than accounted for in a separate goods repossessed. The hire vendor can take back the whole of the asset or a part thereof, depending on the agreement between the parties. The former is called a complete repossession and the latter is called partial repossession. Next, we can see the different types of repossession. The hire vendor can take back the whole of the asset or a part thereof, depending on the agreement between the parties. The former is called complete repossession and the latter is called partial repossession. First, we can see what you mean by complete repossession. The hire vendor closes hire purchaser's accounts by transferring balance of hire purchaser account to goods repossessed account. The hire purchaser closes the hire vendor's account by transferring the balance of hire vendor account to hire purchase asset and then finding the profit and loss on repossession in asset account. After repossession, the vendor may incur expenses or repossessed stock and may sell the same in due course of time. Then we can see the journal entries, the particulars, books of hire purchaser. But in the case of books of hire vendor, when the purchase or sales will be happened, in the books of hire purchaser, the journal entry is asset account debtor to hire vendor account. But in the same case, in the books of hire vendor, hire purchaser account debtor to sales account. Then installment. In the books of hire purchaser, hire vendor account debtor to cash account. But in the case of books of hire vendor, cash account debtor to hire purchaser account. Then interest. Interest account debtor to hire vendor account in the books of hire purchase. But in the case of books of hire vendor, hire purchaser account debtor to interest account. Then repossession. In the books of hire purchaser, hire vendor account debtor to asset account. But in the case of hire vendor account, goods repossessed account debtor to hire purchaser account. Then we can see the partial repossession. What do you mean by partial repossession? In the case of partial repossession, only a part of the asset is taken back by the hire vendor and other part is left with the hire purchaser. The journal entries are as usual up to the date of default in the books of both the parties. As a portion of the asset is still left with the hire purchaser, neither party closes the account of the other in their respective books. Assets are repossessed at a mutually agreed value. The hire vendor debits the goods repossessed account and credit the hire purchaser account with the value as agreed upon on the repossession. Similarly, the hire purchaser debits the hire vendor account and credits the assets account with the same amount. If the repossessed value is less than the book value of the asset which is repossessed, the difference is charged to the profit and loss account of the hire purchaser as loss on surrender. For the remaining portion of the asset lying with the hire purchaser, the applies usual rate of depreciation and shows the asset account as its usual written down value. Next, we can see the sum. Here I have given one illustration. One problem is here. First, just I wanted to read the question, listen carefully. X Limited purchased 3 milk vans from Super Motors costing 75,000 each on hire purchase system. Payment was to be made rupees 45,000 down and the remainder in 3 equal installments together with interest at the rate of 9%. X Limited writes off depreciation at 20% on the diminishing balance. It paid the installment at the end of the first year, but could not pay the next. Super Motor agreed to leave one milk van with the purchaser. Adjusting the value of the other 2 milk vans against the amount due, the milk vans were valued on the basis of 30% depreciation annually on written down value basis. X Limited settled the seller's dues after 3 months. You are required to give necessary journal entries and the relevant accounts in the books of X Limited. In the books of X Limited journal entry, first we can see the journal entry. Put 3 columns, particulars column and debit column as well as credit column. You should put 3 columns, particulars column, debit column and the credit column. First we can see the first year what was happened in the company. Milk vans purchased, right? How many milk vans they have purchased? They bought 3 milk vans. Each van's costing 75,000, right? The cost of one milk van is rupees 75,000. We should calculate the cost of 3 milk vans. So milk vans account debtor to vendor account. 75,000 into 3, 2,25,000. You can write milk vans account debtor. Milk vans account debtor 2,25,000 to vendor account. To vendor account 2,25,000 being milk vans purchased. Being milk vans purchased. The second one is, the second journal entry is for down payment. They have agreed to give 45,000 on down payment, right? So for that down payment, we should write one journal entry. That is vendor account debtor to bank account. Vendor account debtor to bank account. How much is the amount? 45,000. Vendor account debtor 45,000 to bank account 45,000 being down payment made. Being down payment made. They agreed to give interest on the year end, right? The company should give the interest. at the rate of 9%. How can we calculate the interest? The total cost of the milk van is 2,25,000, right? How much is the cost? 2,25,000. Okay. Already we have made the payment 45,000. So you should subtract 2,25,000 minus 45,000. 2,25,000 minus 45,000. How much is the amount? 1,80,000. For this 1,80,000, we should calculate interest. So you just put the working notes, 1,80,000 into 9 by 100. 1,80,000 into 9 by 100. You will get 16,200. Okay. For that interest amount, the journal entry is interest account debtor 16,200. 16,200 to vendor account. To vendor account. To vendor account. To vendor account. Okay. So the next journal entry is they are making the payment, right? What is the agreement? They have agreed to pay the 3 equal installment. Already they have paid 45,000. Now the balance 180,000 are there, 1,80,000 are there. That 1,80,000 they are agreed to give 3 equal installment. 1,80,000 divided by 3. How much amount you will get? 60,000. Already interest is here, right? 16,200. Okay. So you should give that amount, right? So you can write the journal entry, vendor account debtor to bank account. Vendor account debtor to bank account. Vendor account debtor 76,200. That is 60,000 plus 16,200. To bank account 76,200. To bank account being the payment was made. Okay. Then depreciation at the rate of 20%. We should calculate the depreciation for that machinery, right? For that depreciation, we should calculate the journal entry. What is the journal entry? Depreciation account to milk vans, right? So first we should calculate the depreciation amount. 2,25,000. 2,25,000 into 20 by 100. Into 20 by 100. From this 2,25,000, we should calculate the depreciation. This is a diminishing balance method, right? So 2,25,000 into 20 by 100, you will get 45,000. Okay. Depreciation account debtor 45,000. To milk vans account 45,000. Okay. To milk vans account 45,000. Okay. Then we should calculate the profit and the loss. We should calculate whether it is profit or loss. Here I have given some of the calculation about it. The Super Motors Limited as well as the milk vans account. Okay. First you come to this calculation of milk vans account. After that we will, after saying these workings, we'll move for that journal entry. Okay. You come to this milk vans account. You should put 3 columns in the debit side and 3 columns in the credit side. Date column, particulars column, amount column. The credit side also date column, particulars column, then amount column. You should put 3 columns Okay. Two supermotors. The milk van account. Two supermotors. How much is the cost? 75,000 into 3, right? 2,25,000. 2,25,000. In the year end, we are calculating the depreciation, right? How much percentage? 20%, right? So you can write here by depreciation account. By depreciation account, already we have calculated the depreciation 2,25,000 into 20 by 100. How much? 45,000. You can write here 45,000. Okay. Just you put the total in the debit side 2,25,000. 2,25,000. The credit side also 2,25,000. By balance CD 1,80,000. 2,25,000 minus 45,000. 1,80,000. You brought down that balance. Two balance BD. 1,80,000. You should write for the second year. Two balance BD 1,80,000. Okay. The second year end we should calculate the depreciation, right? Which amount we should calculate? 1,80,000, right? Because this is a diminishing balance method. So we should calculate the depreciation for 1,80,000. So you can write 1,80,000 into 20 by 100. 1,80,000 into 20 by 100. You will get 36,000. So you can write here by depreciation in the amount column 36,000. Okay. Then we should calculate the supermotors value of the two vans cost after the depreciation for 2 years. Okay. Two motors, the companies are going to take it. Okay. The cost of the two motors, how much? 1,50,000, right? One motor cost is 75,000. So that's 75,000 into 2. You will get 1,50,000. For that 1,50,000, you should calculate the depreciation. How much is the depreciation? 1,50,000 into 30 by 100. Because why we are calculating 30% depreciation for this two machine? They have given in the question. What is that? The milk vans were valued on the basis of 30% depreciation annually on written down value basis. For which vans? The vans which they are going to take with them. Okay. So you can write here 1,50,000 into 30 by 100. 1,50,000 into 30 by 100. You will get how much is the 30%? 45,000, right? So you can write there 1,50,000 minus 45,000. Then for the second year also, we should calculate the depreciation. For the second year also, we should calculate the depreciation. How can you calculate? 1,05,000 value or there, right? 1,50,000 minus the depreciation value 45,000. The balance amount is 1,05,000. So 1,05,000 into 1,05,000 into 30 by 100. (1,05,000 into 30 by 100. Just to calculate the depreciation. How much is the amount? You will get 31,500. 31,500. Already the amount is 45,000 depreciation value is there, right? So total depreciation value is 76,500. Okay, 76,500. So the total value 1,50,000. Just you subtract this 76,500 for the 2 years depreciation, you will get the balance 73,500. 73,500. You can write here by super motors. In the bracket, you should write value of 2 vans after depreciation for 2 years at the rate of 30%. You can write it in the amount column 73,500. 73,500. Next, we should do one more calculation also. We should find out how much is the profit of the particular company. So next you come to this next calculation. Next calculation, we should find out how much is the profit or loss. How much is the profit or loss? Okay. See here, I have given one more workings. Total value of the vans, all the 3 vans, 2,25,000, right? 2,25,000. 2,25,000. Already we have made one single payment. Okay. That is down payment 45,000 we paid. Okay. 2,25,000 minus 45,000, you will get 1,80,000. 1,80,000. 1,80,000. Then you come to this depreciation part. We have calculated the depreciation for 36,000, right? Here the depreciation also there. For the second year, we should subtract the depreciation. 1,80,000 minus 36,000. This second year depreciation, you should subtract. Okay. How much is the amount? 1,44,000, right? 1,44,000. So this 1,44,000, the companies are going to pay for 3 machines, right? 3 vans, right? 3 vans are there. So we should calculate for only 2 vans. So 1,44,000 into 2 by 3. 1,44,000 into 2 by 3. You will get 96,000. You will get 96,000. Already we got the value 73,500 are there, right? So 96,000 minus 73,500. 96,000 minus 73,500. You will get the balance amount. We will transfer that amount to the profit and loss account. We will transfer that amount to the profit and loss account. That is 22,500. This 22,500 we are going to transferring to the profit and the loss account. Okay. So then just you put the total 1,80,000 1,80,000 in the debit side. Just to come to this credit side, just to roughly total that all three amounts: depreciation, super motors values 73,500, and profit and loss account balance 22,500. You will get 48,000. 48,000. You can write here by balance CD. By balance CD. 48,000. Right? By balance CD. 48,000. Here, see here. Here we want to make one journal entry. Profit and loss account. Profit and loss account. 61,200 to depreciation. Depreciation already we have calculated, right? 45,000. Then interest. Interest also we have calculated here. Okay. 16,200. That both the amounts we should transfer to the profit and loss account. Then we'll move for the second year depreciation. Second year we are going to calculate the depreciation 20%. Already we have worked out 1,80,000 is the total amount, right? So 1,80,000 into 20 by 100. 1,80,000 into 20 by 100. You will get 36,000. So depreciation account debtor 36,000. Then 2 milk vans account debtor 36,000. Okay. Depreciation account debtor 36,000. 2 milk vans account debtor 36,000. Okay. Next, interest account debtor to vendor account. The balance amount we should calculate the interest, because here already we have made one payment, right? Here 60,000 we paid. That is 1,80,000 divided by 3, 60,000 plus that interest also we paid, right? So for the remaining amount, 1,80,000 minus 60,000. Remaining amount how much? 1,20,000, right? For that 1,20,000 we should calculate 9% interest. So you can write here 1,20,000 into 9 by 100. 1,20%, 1,20,000 at 9%. Okay. You can get 10,800. So just to write it. Interest account debtor 10,800 to vendor account debt. To vendor account 10,800. Then we can see for loss in repossession. For loss in repossession. What is the journal entry? Super motors account debtor 73,500. Profit and loss account debtor 22,500. Right? Already I have shown you how to calculate this profit or loss, right? 22,500. The value is 96,000 minus 73,500, right? So when you will get the balance amount, we should transfer that amount to the profit and loss account. Super motors account debtor 73,500. Profit and loss account debtor 22,500. 2 milk vans account. 2 milk vans account. How much? 96,000, right? 96,000. The second year. Okay. Depreciation account debtor 2 milk vans account. The next year, how much is the cost of the milk van with us? Only the 48,000, right? You can see that 48,000 only with us, right? Already I have explained you milk vans account 48,000. For that 48,000 we should calculate 20% depreciation. You can write depreciation account debtor 48,000 into 20 by 100. Depreciation account debtor 48,000 into 20 by 100. You will get 9,600. You will get 9,600. to milk vans account, 9,600. Then they are going to settle the accounts. Just we can see how much is the amount with us. Okay, super motors account. For that, we should put on workings, super motors account. You should put 3 columns in the debit side, 3 columns in the credit side. Year, particulars, amount. Then credit side, year, particulars, amount. The first year, to bank account, 45,000, right? Because they have given 45,000 for down payment. Before that, you should write it by milk vans account. By milk vans account. How much is the cost? 2,25,000, right? 75,000 into 3. You can write in the total column 2,25,000. In the debit side, you can write to bank account 45,000. Again to bank account, they have given the another payment 60,000 plus 16,200 interest. Okay, that interest also we have calculated. See here, by interest at 9% on 1,80,000. I have explained you that amount is 16,200. Okay, so you can add it 60 plus 16,200, 76,200, right? Put the total 2,41,200, both sides 2,41,200. So the balance, when you subtracting this, you will get 1,20,000. 1,20,000. You can write here to balance CD. 1,20,000. Okay, 1,20,000. Then you come to this next year. You brought down that balance by balance BD. By balance BD, 1,20,000. Then we should take the cost of milk van, right? So you can write to milk van. Already we have calculated that amount, 73,500 here. So you can write here to milk van, 73,500. 73,500. For that year, the interest rate is 10,800. 10,800. That also I have explained you already. By interest account, 10,800. You should write here 10,800. Just you put the total 1,80,500. 1,80,000. Sorry, 1,30,800. 1,30,800. Just to subtract it and find out the balance. To balance CD. To balance CD. How much is the amount? 57,300. 57,300. Okay. For this, we should put one more journal entry here. Vendor account debtor to bank account. Vendor account debtor to bank account. How much is the amount? 57,300, right? So you can write vendor account debtor 57,300. Vendor account debtor 57,300. To bank account 57,300. To bank account 57,300. Okay. Thank you.